Welcome to the Infra Insider podcast from Infra-Be, a leader in renewable energy and infrastructure executive search. Join us as we dive into insightful conversations with industry leaders, pioneers and visionaries shaping the future of infrastructure and renewable energy. Discover the latest trends and innovations and challenges driving the transition towards a greener and more resilient future. Please remember to like and subscribe. We are joined today by Haydn Palliser, Principal at Pivotal 180, with over 20 years of experience. He's an expert financial advisor specializing in renewable energy and infrastructure. His passion is educating and engaging the next generation to ensure they are best equipped to provide value from the first day on the job throughout their careers. This is what his business, Pivotal 180, are currently doing and offering on a global basis. Today, our discussion is focused on the US renewable energy market, and Haydn is going to expertly navigate and explain the complexities around tax structuring. So without further ado, Haydn, welcome to the Infra Insider. It's a pleasure, and it always is a pleasure to speak with you. We go back decades from all the time when you were a financial modeler in the UK, and it's been great to have followed your career. And as you know, I'm a very, very big fan of Pivotal 180. Haydn, tell us a bit more about yourself, and please give us a further explanation and insight into Pivotal.
Sure, thanks for having me, Daniel, and the pleasure's all mine, I assure. Thank you for inviting me along here. I do feel a bit old, though, when you said I've got 20 years experience, but that is true. I realize
I think we're both getting a bit old, actually. That's the problem.
I know, I keep growing grayer. I'm not sure why. So look, 20 years really on the advisory side, right? So M&A, financing of projects, building lots of financial models, and I'm certainly a geek when it comes to the analysis of projects, and also a professor, teacher at Yale and Columbia University in the US.
Wow.
And I guess relevant to the discussion here is Pivotal 180. And Pivotal 180 is, I would say, the leading trainer in tax equity, project finance, and financial modeling in the US, focused on renewable energy, obviously with the tax equity part, but infrastructure, mining to some degree as well. And although we might not be so well known across in the UK and in Europe, definitely sort of the biggest player in the market in the US. And I think what's important about Pivotal 180 is the instructors, the teachers like myself, we actually have done deals. We understand that structure, and we don't just teach modeling, we teach analysis of deals, how to sort of optimize things. And we also teach the legal documentation, sort of risk transfer, legal agreements, loan agreements, and those sort of things. And so I'm also from New Zealand, by the way. I know I do not sound American. I do live in New York, but I'm from New Zealand, but I've been here for nearly 10 years.
Wow, amazing. And obviously enjoying yourself. I think the interesting thing about financial modeling, and it's something that we've talked about on previous episodes, it bears the foundation of pretty much every single infrastructure renewable energy deal, whether you're an infrastructure fund, whether you're a developer, whether you're a utility, whether you're an advisor. I think the important thing is that financial modeling is continuously adapting, and because of that adaptation, I think we always need to refresh. And that's why for many of my clients across the space, why they're continuously using trainers like yourself, because let's face it, a bad financial model can end in a catastrophe and a terrible investment.
I've got plenty of stories on those.
I know I've probably got a few myself, to be fair. Look, the US renewable energy market, for those of us, I think, in Europe, is difficult to comprehend. And I think the difficult comprehension is around the tax equity side of things. Can you tell us a little bit more about tax equity and why it's so important in the US renewable energy market at this current moment?
Absolutely. Look, I arrived in the US 10 years ago, having sort of worked in Asia Pacific, having worked in Europe and Africa and the Middle East. And when I arrived in the US, it was a complete shock to me about how things worked. And it was really hard to understand it. And maybe more holistically in the US, if you think about the US and the renewable energy market, I could talk about how the US is a land of opportunity right now. I think just the sheer scale of things in the US, the rapid innovation, the ideas, the new technologies that are coming out. I could talk about sort of the crazy financial instruments that are now available in the US, or even the risk structures, some of which might make some of the Europeans balk at what we do. But I don't think those things are the main difference. As you sort of said, casting aside maybe certain political risks, cultural differences, pay structures, the challenge that most of my clients face entering the US, I would say is twofold. I think clearly tax equity is part of it, but I think maybe first it's actually the multiple different markets and submarkets. And I got told this all the time before I came to the US. It's not one country. It's 50 different countries. And I sort of thought, yeah, sure it is. I kind of get it, but is it really? But it truly is. The offtake structures, how you sell energy vary by region, by utility, by state. Even how you sell energy into the open market varies by the market you're in, the instruments available to you. So if you're thinking about the US, you can't say, I'm going to invest in the US. You have to actually pick localized regions. And just the sheer scale of the US means you can focus really narrowly on things and still have a big market. But clearly, look, legal and tax structures is the tough thing. And having spent time all around the world doing project finance, look, there are regional differences in Asia and Europe and the US, in Africa or wherever. There are differences, but largely from a renewable energy perspective, they're kind of the same. We negotiated PPA prices that were enough to cover the costs and, make a certain return. Look, and people might look at me and say, that's a ridiculous thing to say. Every market's different credit issues. But still, it was relatively, or maybe comparatively easy to jump around other countries compared to jumping into the US. The US is not a typical financing structure. So part of the reason for that is if you think about how the US has approached renewable energy, is if you go back 10, 15, 20 years when renewable energy was expensive, what happened is federal governments often came together and said, look, here's our high energy price that we're going to offer you that's enough to cover the high cost of renewable energy. That was the idea behind it. But the US federal government couldn't do that. No president in the US is going to dictate prices in Texas and Maine and across to California. There will be all sorts of problems on the streets in the US if they do that. And so we have a bunch of local energy prices that vary by state and regions, but largely what the US government did was provide federal tax benefits. And what I mean by that is federal accelerated tax depreciation and something called tax credits. And to put it in perspective, I'll talk a little bit about what these things are, is about 30 to 60 or 70% of the present value of our projects in the US is actually from tax benefits, not from cash.
Wow.
That is a fundamental difference. And it's really, really hard. And it's really, really complicated.
Can I ask you, when did those, should we call them tax initiatives or incentives, when did they come into play?
They've been around for a long time, for like 20 years. They've been around for a long time, but they have evolved. And one of the biggest challenges we've actually faced in the US is that the tax benefits on offer have constantly been pushed around, extended, changed. And, it's been really hard to sort of deal with that volatility. One year the credits are falling away, the next year they're not. And if you're investing in renewable energy, you don't really like volatility, right? The only people that like volatility are options traders. So it's been this constant flow of changing credits over time. So they're not new, but I will say they have increased in value substantially with the IRA, which I'll talk a little bit about later.
Yeah. So look, the renewable energy market is incredibly attractive. We can see that there's lots of European developers and investors who have been running at the marketplace. The tax incentives, I'm sure, are front and center. So, can you elaborate a little bit more on the tax incentives and actually what makes it so difficult?
Yeah, look, first I will say it is by far the hardest thing I've ever learned in a professional setting by a long way. The hardest thing maybe it compares with, partial differential equations at university or something, right? It's really, really hard to understand. It's not complicated math, so to speak, but the structure is difficult. So let me explain it a little bit. I think what I'll have to do is start with like what those things are. What are the incentives? Yeah. Then I'll talk a little bit around how do you monetize them, because that's kind of getting to the meat and the bone, so to speak. And then I'll come into the structure of how these things are done. And I'm going to have to assume a little bit of knowledge around energy for people, so people know what a megawatt hour is, and a little bit of basic tax knowledge, just given the time we've got. But I'll sort of break this out pretty slowly. I mentioned earlier that there's two incentives. Federal tax incentives in the US, and there are state and local incentives too, by the way, just to make it more complicated. But the first one I mentioned was something called accelerated tax depreciation. Now, I'm assuming people generally know what depreciation is, but I'll touch on it. If you think about taxable income, first of all, the only reason taxable income is something we calculated is we pay tax on taxable income. So what I'm showing you here is something called EBITDA. Just think of that as revenue minus costs. And let's assume, forget debt, there's no depreciation. Your taxable income here would be 500. And the reason it's important is we calculate taxes on this amount. So in the US, the federal tax rate is 21%. There's state taxes on top. But at a federal tax rate of 21%, we pay tax on 500 or $105 in this case. Now, depreciation, if I add depreciation to this, just to understand the value of it, first recognize depreciation is not a cash item. It's just if you spend $100 million in capital costs up front, you are able to expense that over time. If you think about like labor costs of people in your business, Daniel, you expense those each month as those things, those costs are incurred. But depreciation is just expensing a capital cost over time. And so this is not a cash thing. I've spent the money, but if the government allows me to depreciate, what that does is what we call an expense. It lowers the income, and then we pay less in tax. So first of all, depreciation fundamentally lowers our tax bill. And in this case, $100 of tax depreciation lowered my tax cost from 105 to 84. That's a difference of 21 cents or $21. And the way to think about this is every dollar of taxable income that you have, a tax rate of 21 cents, you pay 21 cents in tax, right? So if you think about income costing you 21 cents in tax, every dollar of depreciation you get lowers your income by $1 or saves you 21 cents in tax. And the reason this is so important is in the US, for wind projects, solar projects, or battery energy storage systems, BESS, they qualify to depreciate 90% of their capital costs roughly on what we call a 5-year accelerated depreciation. So if you spend 100 million, you can depreciate that over 5 years. And there's a special thing I won't go into called MACRS, modified accelerated cost recovery. But basically what that does is if you spend $100 million, for example, and you depreciate over 5 years, you end up with big taxable losses. Okay, that's the idea behind it. And the key takeaway from that, without going into numbers, is basically that depreciation lowers your tax by quite a lot of money. And from a present value standpoint, if every dollar you spend on CapEx, that depreciation is worth about 10 to 15 cents today, right? That's a lot. You spend $100 million, well, you've got about 10 to $15 million of benefit from depreciation on a present value because you get that over 5 years. So that's a big benefit in itself.
Yeah.
So that's sort of benefit number one. And there's a lot more behind this, but that's the general idea. The bigger thing probably is tax credits. Now, tax credits are available for lots of technologies, but focus on wind, solar, batteries. The thing about tax credits is they offset taxes due. So, Daniel, if you had $3 of tax, and you get a very good tax year, you pay $3 of tax. If you get a
Didn't
tax
pay
credit,
that much this year.
Maybe next year. Cross our fingers. So if you had $3 of tax due,
Yeah.
and if you earn $2 of tax credits, you only pay $1 of tax. So it directly offsets every dollar of tax. So it's very, very valuable. You know, $1 of depreciation saves me 21 cents, but $1 of credit saves me taxes by $1. This is actually the bigger value driver of these things. And in the context of wind, solar, batteries, there's two types of tax credits. The first one is what we call an investment tax credit, ITC. And when I say we call it that, that's what the IRS calls it. And we have another one called a production tax credit, or PTC. Now, these are much more of the value of projects, and I'll go into like just the value of these shortly. But the way it works is solar and wind projects can elect either of these credits, not both. You can't have both, but you can have one of the two. And you can do some very simple analysis to decide which you'll do, and I'll come to the numbers in a second. And batteries qualify for the investment tax credit. The production tax credit, as I'll come to in a second, is based on producing energy, and batteries don't produce energy, they use energy. You know, you maybe get 80% of the energy you put in back out, roughly speaking. So batteries qualify for ITC. Now, there's a bunch of interesting stories on these, but just the high level set of these numbers to give you a sense of.
By the way, I'm loving these. By the way, I'm loving these slides. You're the first guest on the show that has brought slides, and also thank you for making tax interesting. I wish you were my economics teacher at school. Please go on.
Well, I wonder what went wrong in my life that I've become someone that teaches tax, but you know, it's one of the truths of life of life is that we have to pay taxes, right? So these credits are really, really valuable. Now, the first one I'll talk about is this investment tax credit, ITC. Remember, solar and wind can do this one or the other one. Batteries can only pick this. This has been historically used for solar. And by the way, Daniel, if you love tax, Section 48 of the tax code, the IRS, that's where you can go digging to learn more.
I'll earmark that for my bedtime reading.
It'll put you to sleep. That's the bright side. So this is $1 for dollar offset of taxes due. You know, $2 of credits saves you $2 in tax. The key about this credit is it's upfront. So what happens is you build a project for, say, 100 million. As soon as you place that project in service, essentially turn it on, you've earned this credit. Okay. Now, the thing about that is this credit is worth somewhere between 6 and 70% of project value. So, and think of project value for the purposes of this sort of light touch, as it's the construction cost. So if I spend $100 million to build something and I get a credit, I'm going to use 30%. That's a pretty normal sort of number. If I get a 30% credit, I spend 100 million and I get this credit worth 30 million right after I finish construction.
Yeah.
Okay. And the way the US works, and most countries around the world, you pay tax quarterly. So if I build this project and finish building it early January of a year and I pay tax, say, in March, I basically pay 30 million less in tax in March. That's like giving you back 30% of your capital costs. It's huge. Okay, so it's a really, really big credit. So it's a big credit.
What's the average build cost of a project? Let's say a solar project in the US.
Yeah, good question. So, you know, solar projects, people talk about $1 a watt, you know, or $1 million per megawatt.
Yeah.
That's kind of the range for big utility scale solar. Like if you go and do residential, 2.5 times that or something.
Yeah.
If it's smaller scale, it's somewhere in between. But like it's relatively cheap. I mean, costs have moved around with the supply chain recently. Wind is about 30% more expensive in that construct, but you're getting 30% of your money back through these credits essentially.
So the fundamental bottom line here is that building projects in the US could potentially bear far greater profit than in Europe.
Yeah, so sort of, yeah. Like what happens is, because fundamentally what most investors are doing is they're sort of working out their costs and what return they need and sort of back calculating what's the energy price they need and negotiating that. What these credits ultimately do is if you're trying to work out, like back calculate what energy price you need to hit a certain post-tax return, if your taxes are less because you've got all these credits, it lowers the energy price. And so one of the things that is happening is our energy prices can be lower because of all these tax incentives. We're just subsidizing energy prices fundamentally because there's an argument you don't need credits, right, in the market. You don't need for solar or wind because it's cheap. And I'll come back to that a little bit later with some interesting policy bits, but that's the idea. You do lose a little bit of depreciation value, by the way, here. So if your project's 1,000 and your credit's worth 30%, you earn this ITC of $300, but you can no longer depreciate the full value of the asset, say 1,000.
Yep.
Half of what the ITC is, that's 300. You can no longer depreciate. So you get this 30% money back on your capital cost, but you lose a bit of depreciation benefit. But that's functionally what the ITC is. That the problem with these credits, and the same with depreciation, is, these credits are great if you have taxes due. But if Daniel, you had $3 of tax due, and I gave you $10 of credits, you can only use $3 of credits this year. The other credits you have to hold on to and use them one day in the future when you have taxes due. And so you can hold on to these credits. They do expire after 22 years. It's not normally a problem. You also, this is a really funny story.
That's important though, isn't it? Because if you're a first-time investor coming over from Europe, you're not going to build that up yet. So you're obviously coming in for the long-term period. You want to know that you can hold and accumulate. So that's obviously positive. And 22 years is a pretty long span, which is great.
It is. You're at a disadvantage being a European in that sense, though, because if I get a big tax credit today and I can use it today, present value wise, it's way better than if you came across and could use a credit in 10 years time, right? So I've got a big advantage having US tax liability, so to speak. This is kind of a funny credit because it's all based on capital cost, right? It's got nothing to do with how well the project performs. But this is a really big credit. And let's call it 30% roughly historically. I'll talk a little bit about these ranges now. But that's one credit. The other credit, and it's kind of easier to understand, is something called the production tax credit, the PTC, Section 45, the tax code for your reading. It ranges between, say, 0.55 cents per kilowatt hour or 3.3 cents per kilowatt hour, or 3.3 cents per kilowatt hour is $33 a megawatt hour. Now, what you've got to realize, this credit, it was set a long time ago, and every year the IRS basically, as 0.3, it started at 0.3 cents per kilowatt hour, and every year they release some like inflation factor to say what it's worth now. But the key thing is this one actually inflates over time. So it's a set value when you start your project, but it goes up with inflation. The key about it is this is something that's based on production, on the amount of megawatt hours or kilowatt hours you produce. And so you get this over 10 years. 10 years from when you place it in service. Now, what you also have to realize, like, think about these numbers, right? Let's say it's a number that people quote is somewhere in between these numbers, 0.55 and 3.3. People quote 2.75 cents per kilowatt hour or $27.50 per megawatt hour. This is a post-tax number, right? If you get an energy price that you sell, you pay tax on that, but this is comes off your taxes, so it's a post-tax number. So, if your tax rate's 21% or 20% on a $30 per megawatt hour production tax credit, it's actually worth like $36 or $37. It's a big incentive. This is like a government PPA basically to a project. It's the US federal government, the risk-free rate sort of off-taker. And like, just to be clear, if my value of my credit was $27.50 per megawatt hour, I simply take the generation. I have to actually, I've got to sell this energy. I can't just, let the turbine spin, but I sell the energy and that's my PTC. It inflates. This is the key thing from a risk standpoint. It inflates over time. So all you do is you forecast, like any other energy project, you forecast your generation and you multiply it by this price that's federally set. That's the idea. Now, again, if I don't have taxes due in this year, I can hold on to them until I do. But I lose present value if I can't use it today.
Yeah.
Now, this credit is fundamentally different because it's based on actual performance of an asset.
Yeah.
The ITC, if I built a project in Alaska, or Arizona, Alaska, not much sun, Arizona lots, there's no difference in value, but this one production tax credit that would, because you'd get more sun in Arizona. So just fundamentally what I'm talking about, ITC is about 30% of the capital costs, roughly, and you get that right up front. PTC.
We like up front.
We do. It works really well. And remember this, and what this is, it's not like a cash payment. What it fundamentally is I pay that much less in tax. But
so I don't like it that much. Okay.
At least if you have lots of taxes, you would love it a lot, right?
Yeah, absolutely.
Because like it's still a positive cash flow to me in that sense. Now, sort of so there's the two credits, the ITC and PTC, and there's depreciation. Now I'll come to the value of the credits a bit more, but sort of how do we monetize these? Well, within the US, we've got this structure. We've got these like project assets that are owned by an SPV. That's nothing different to renewables in Europe, for example. These SPVs are typically set up as a limited liability company. And you might wonder why I've made a triangle. It's not because I like triangles. I mean, I do. Nothing against them.
And by the way, if you are tuning in on Spotify, if you do direct yourself to the YouTube version, what we are looking here is some incredibly detailed slides that might make more sense. But thank you, Haydn.
Yes, absolutely. I think I would encourage people to look at the slides. So what happens is these SPVs, this triangle basically is just saying that this is what we call a pass-through structure. Basically, the SPV doesn't pay tax. The SPV passes any credits that I've talked about or any depreciation I've talked about isn't useful at the SPV level. That just flows up to whoever the equity investors are. And I'm showing two investors here. And why that's important is this. Like, so let's just pretend there's one red box. This is the corporate that owns an SPV. Like it could be an infrastructure fund. I mean, it could be anyone really. So this is a European infrastructure fund. So here's my tax equity or an equity investor. If they had, say, income of 100 and the project had 10 million of income, well, that 10 million just flows up to tax equity. Now their final corporate taxable income is 110. And all I do, the reason I calculate taxable income is to times it by the tax rate, 21%. So if this equity investor came into this project, they would pay 2.1 million more in taxes. Forget cash for a second.
Yeah.
Cash is kind of like a secondary thing in the US in a way. But you know, what would happen if this project had a loss? If this project had a loss, it would flow up to this investor. So with 100 million of income minus 10, they've got now taxable income of 90. What's happening is they're saving 2.1 million in tax from their 100 they would have had in the first place, because this 10 million has lowered their income by $10 million, right? 10 million times 2.1. Yeah. So this is awesome. This is awesome from an incentive standpoint, because we can just pass up these losses up to someone who's actually got paying tax. They can lower their tax bill. And you think about this from a big corporation standpoint here, they would be saving 2.1 million in tax from doing this because they have taxes due. If there's credits earned here, the same thing, they flow up. So if I was a big tax corporate paying entity in the US, like JP Morgan, for example, I can use these credits today within this quarter.
Yeah.
The problem is, you know, if you're a European, you don't have US taxable income, you can't use the depreciation of these losses. You can't use the credits today. If you're a pre-tax infrastructure fund in the US, you can't. And most developers don't have taxable income because they keep developing projects.
Yeah.
And so what we end up doing is essentially, and you can't say this, you know, give us in our courses, but we essentially try and sell the tax benefits to like JP Morgan or Bank of America or Wells Fargo or US Bank. Those four names I mentioned are like 75% of what we call tax equity investors. What they do is they come in and they essentially buy those tax incentives. And to tax equity, if you can use the benefits today, there's a higher present value than there is if you're a European sponsor and can only use the benefits in 10 years' time. So it's just a present value play on taxes. And so tax equity comes in and buys the taxes. You can't actually just buy and sell, but that's the idea. Now, to put it in perspective, historically in solar deals, tax equity might have put in 30 to 35% of the capital. That's how much these tax incentives are. In historical wind, it might have been like 60%.
Oh, wow.
So that's how big these incentives are. So like, it's not so much about cash from a holistic overall project standpoint, but obviously, you know, as a equity investor, you want cash.
Yeah.
So clearly figuring out how to monetize these incentives is really, really important. Really, really important. So just really high level. And this is a complicated topic.
You've got all the answers. So that's, you know, that's the important thing when you're navigating your way through this.
That is true. It was a hard learn, I can tell you. But here's how it kind of works, right? Now, what happens is when we invest in these projects, you've got this SPV, like a normal European SPV type thing. And, I've got a tax equity investor who's coming in to buy the tax benefits. And largely they do a present value of the tax benefits and at a cost of capital. And that's how they size their investment, just like debt does it, just like equity. We discount equity's cash flows at equity's cost of capital. Debt discounts their cash flows at debt's cost of capital. So they come together. Now, don't worry about these holdcos, but basically these two parties come together, tax equities buying the tax incentives. The sponsor's happy for that because they can't monetize them today. And they enter into a US partnership. And there's a bunch of crazy rules here, which are also really fun to explain, but we need another hour. But what happens just indicatively is what we structure the partnership to do is give, almost all the tax benefits to tax equity. Say 99% of the losses of the depreciation, 99% of the credits, and we give them some cash. I'm just arguably showing 20%. The sponsor, basically gets very little amount of tax because they can't monetize it today, but they take most of the cash, which, we all love getting cash. I can buy dinner with it. But what sort of happens and what's really hard for some of the European lenders in the US is European lenders, they're used to lending straight to a project company. But what happens is lenders lend to this, there's a special holding company set up owned by the sponsor. Lenders lend to that. They get paid from the sponsor holding company, and we call this back leverage debt. Fancy name for holding company debt. And without going into the weeds of it, the back levered lender is actually partly subordinated to tax equity. That's a hard concept because project finance debt senior to equity. Well, sorry, not anymore. Not in the US. With tax equity has some rights that can actually put lenders in default. And of course the sponsor gets money left over. So like the thing is with, project company would normally pay the lender and go to the sponsor. Here we're giving a bunch of tax incentives and some cash to tax equity. And so that is a really, really challenging position to be in for sponsors. And to kind of make things worse, tax equity gets, let's call it a 7 to 9% IRR. Now, two things about this. One, this is a post-tax return. And they're, this is kind of crazy because they're getting this 7 to 9% return. And like if the project underperforms, they get less cash, but they get more losses. And actually at a 20% share that I've done here without going into it, they're actually pretty hedged on performance. So their main risk is the credits, the off-taker being the US Fed. So it's a pretty good position to be in. Lenders, let's call it 5 to 6% all in interest. This is a pre-tax amount, and they're subordinated to tax equity. And then the sponsor could be about the same as tax equity. And that's a crazy, crazy idea. And you think like, how and why and what the heck is going on? And when I got to US, that was my first question. I think I still have the question. But largely, this is all because most sponsors, most equity investors don't have tax capacity. They don't have taxes due today. They can't use the credits or the losses. So there's just not enough tax equity investors because to do this and without going to there's about a $20 billion market, without going into it, this is really complicated. Like this hasn't been the easiest of topics to understand.
Is that complicated? It's that complicated. It's somehow done something to my lighting here. So
if I start mentioning some really crazy tax code references, it'll get worse.
You created a stem of lightning here.
I wasn't sure if that was a disco. Maybe you're just getting excited.
To be fair, the disco's later when we celebrate. Sorry, carry on.
No, so the thing about this, and whilst the concept is complicated enough already, what gets really, really hard here is the partnership rules and the tax accounting, so to speak, are the hardest thing I've ever had to learn in a professional environment. It's just mentally exhausting. And what that's meant is people have kind of ignored it a little bit and just had it as a black box, which to me in a project finance concept is just silly. Like if you're an investor, you've got to understand your deal. And people have made a lot of bad mistakes because they haven't understood the calculations here, and it's caused massive problems on projects. In fact, the first two projects I worked on here were restructures. And the CFO of the sponsor that I will not name had no idea why this was happening, how it was happening, because it was just this black box on the side that they got told.
I mean, you'd hope that people would come into it with their eyes open But hopefully this podcast today offers the further information required to actually enable people to assess whether or not the US renewable market is the right space for them.
Yeah, look, and I think it's a great place. It's just you have to bring in local expertise. It's one of the first things I did. But what you'll find, and there's a lot of people that pretend they know tax equity, but they don't.
Yeah.
And so you've really got to know that they know it and understand it, because everyone talks about the fancy words, but they don't know how to do it. And look, I think I'll come to the IRA in a second, but there is more investors coming in. We're seeing more of that happening.
Yeah, no, absolutely, and we've seen it as well. I had never seen a renewables market so buoyant, which is exciting. Great for a recruiter, great for an investor, but yeah, great for the economy, great for sustainability. It's a hot area. I will say though that over the year there has been a number of our clients based across Europe that I think have loved the idea of it, but maybe got put off by the complexities that we've already discussed.
A brief interruption. At Infra-Be, we are more than just creators of the Infra Insider podcast. We're a distinguished team dedicated to the global infrastructure and renewable energy market. Our specialisation lies in offering comprehensive talent solutions to banks, equity providers, funds, sponsors, developers and contractors. We are the go-to experts for talent acquisition throughout the entire infrastructure and renewable energy lifecycle. To discover how we set ourselves apart in finding the absolute best talent in this sector, please don't hesitate to get in touch with us through the contact page on our website. Thanks for listening, and back to the podcast.
Okay, so here's one thing that we can conclude already, and that is clearly that tax equity matters. I've heard and I've read and I've tried to understand the Inflation Reduction Act, or the IRA as we refer to it. I read that you can somehow sell the tax credits. I don't know if that's right or not. Does that mean things will get easier and tax equity will no longer be required?
So to the first part, will it get easier? Yes, to some degree. No, another degree. Will tax equity go away? I don't think so. When I arrived in the US, I thought this structure cannot continue. It's going to go bye-bye. Say bye-bye to this silly structure. I was wrong, very wrong. And now I don't think it's going away. So I could be wrong. But I'll take a little bit about the market, because the tax equity market's about 20 billion. And the reason there's not enough players in the market is not about US tax capacity. There's other people that can do this stuff. It's about the complexity. Really, really hard. And I'm already seeing, and I'm working actively with a few new tax equity investors entering the market. So we're seeing more of them come. How they work is going to be a bit different. But just on the IRA, right? There's the two main points. I mean, there's a lot of points. In the context of wind and solar, tax credit structure's been changing, so they're actually going up in value, which is a problem when the tax equity market's too small. But let's say the ITC was 30% before. Now it's ranging between 6 and 70, and it goes up if you use some domestic content. You put projects in areas where they've traditionally relied on fossil fuels into lower socioeconomic areas and a bunch of other things, but they're going up in value. But our tax equity market's not, right? So that's going to be a challenge for us. And to recognize this, if you're a smaller developer or you've never done anything in the US and you don't have a relationship with the big banks, you're not going to get tax equity. They won't even answer the phone. And that's been a real problem. So we've seen a lot of M&A, the big players coming in and buying small projects, because the projects don't stack up if you can't raise some form of tax equity. And so the credits are going up, and PDC also is going up. So this is going to make it harder in a way. Like the IRA is really a climate bill. We can call it whatever we want, but it's a climate bill, and we're just making more credits into a market that doesn't have enough players doing this stuff. But what they did do, and to make it worse, by the way, I'm not worse. That's wrong choice of words, but they're also now enabling batteries to qualify, batteries that are, I mean, it's a small size, decent size, and like distributed energy now qualifies for ITC. But the key thing, as you mentioned, credits can be transferred in exchange.
Okay, so I was right.
You were right. I know.
Once I was right.
You get an
brilliant.
A. You can get an A today. That's well done.
Thank you. Thank you. I did a bit of research. I didn't go into too much depth because I was lost, but it is all making a lot more sense now. So thank you.
Yeah. So this is a major benefit because you can now sell tax credits to like a big corporate in the US who doesn't want to figure out this tax equity world. So this is a really big benefit. You know, who the buyers are is what everyone's chasing, and it's a very new market. First deals are being done now.
When was it introduced? When was it introduced?
Good question. So it was introduced last summer in the US, the IRA, except nothing happened because what happened is it came out of nowhere. You know, there was this Build Back Better thing that went on, and then Munchkin came in and moved some things around, and just overnight, boom, the IRA came out. No one really knew it was coming. And then the problem is the poor IRS, because all the incentives are tax incentives.
Yeah.
The IRS is like, now we've got to give guidance on what this stuff means. You know, for example, the tax credit said, oh, you need domestic manufacturing to qualify for a higher credit. What does that mean? Do I need every single thing to come from the US? Or is it not? You know, what's a fossil fuel dependent community? Like, they've been struggling to keep up. So the first deals have been happening in the last few months related to tax credit, last like 4 months or so. Like, people are still figuring out, and the IRS is continually releasing guidance. It's really tough. So, you know, the people that make the most money off this, Daniel, are the tax attorneys. You know, they are just very, very busy, and and you need to use them. And by the way, if you're a European thinking about the US market, a big name law firm doesn't mean they're good at this stuff. Some of the big name law firms are really good at it, but you need to get a tax lawyer, and they're going to become your best friend. You know, because the weeds of this and the opinions you need from them to confirm the values of the credits, those things are really, really important.
Yeah, absolutely.
So you can sell credits, which is awesome. You can't sell depreciation though. So that 10 to 15 cents of present value, you lose that. So credit transfers probably aren't as valuable to many investors as doing tax equity, but you might not have a choice, and it's still better than what we had before.
Absolutely.
And those buyers, you know, they're trying to figure out what price they want to pay. You know, that's a big challenge to us. There's a bunch of other changes, but the transferability is the key thing. But as you alluded to, just constant frothiness in the market. Now,
they announce the bill and everyone gets excited, and then everyone sits there thinking, well, what does it mean?
Exactly.
But the excitement was there initially, which always drives investment and drives interest. So, you know, that's why these things are put in place. But I'm sure they're not there to catch investors out. But again, going back to the point, you know, you need the right tax advisor that really understands this space.
Absolutely. And look, I mean, this credit transfer, just to wrap up one little diagram to be clear, the credit transfer, it's basically going back to a normal European tax structure in a way, right? You're going to have someone who buys these credits.
Yeah.
You know, the project company will sell credits for cash. You know, I mean, putting 70 to 95 cents. I mean, like any buyer of an asset, riskier stuff, they're going to pay less. And then you're going to have a normal lender at the project company that maybe provides a normal sort of project finance facility and a tax tranche. And so this is much easier for Europeans, certainly get their heads around, or they might lose value. And when I'm working with most of the Europeans I work with, there's a range, but a lot of them are the really big players.
Yeah.
And they like this, but they're probably going to stick with tax equity because they want to get that 10 to 15 cents of value from depreciation. But this is a much easier structure, but it's still not as easy as you think because there's a huge amount of tax rules, you know. And by the way, they're selling a credit. You can only sell once. So I can't sell to you and then you sell to someone else and blah, blah, blah. It has to be a cash payment. There's no tax impacts. I won't go into that. Key thing is you can't sell depreciation.
Okay.
Probably the buyers will pay less than tax equity because they're less sophisticated.
Okay.
You know, and the buyers don't, you know, if you're buying a PDC, you've got to understand like production.
Yeah.
ITC is harder, but we're going to see a lot of insurance products come in to the market as well. But you're going to need to like see like what's the value of the credit they earn. That's the thing you have to understand. And largely you're going to have to go out to tax attorneys and get opinions. So this is a really good thing. But by the way, the winners of this market are going to be the tax equity investors, because what you're going to see is like the structure, hybrid structure. We're going to keep tax equity, but tax equity will essentially sell the credits and make a profit on that. And that's kind of good from a project standpoint, because you can monetize depreciation with a partnership. But actually, to a large degree, the investment banks are the right people to find buyers for these credits. So we're going to still see a lot of that structure as well. It's called hybrid. I won't go into it because that'll take us another half hour. But we're going to see a lot of hybrid structures where there's still a partnership created, but the partnership sells the credits, and tax equity might facilitate that. So it's really complicated, right? And I'm not scratching the surface. I'll say in my courses I would go through this in more detail, a lot more detail, but I'd say in our courses, we're doing a flyby and just waving to tax equity to understand what it is, but like 30 to 70% of the present value from this stuff, it's really, really big. And so if you're coming into this market, one of my biggest recommendations outside of getting the right advisors is hire some local people as well. They have a real track record, because when I came, it frustrated me with going and speaking to experts that I found out couldn't explain or answer any of my questions. That was really frustrating.
And I'm assuming that, anyone listening in, thinking about investing in the US renewables market, looking for guidance, looking for advisors, I'm sure they can get in touch with you directly and maybe have a peek at your Rolodex of key contacts and advisors. And what we'll do is we'll put some contact information in and around the pod so that people can get in touch with you on that.
Yeah, and there's some good. Maybe in that I can send you a few links to some good. Some of the law firms have some good.
Actually, but probably what would be quite interesting is actually, if people can get in touch with you as well, maybe to get a hold of this presentation as well. I know that the slides have come on clearly, but it might be an interesting reference point to look back on this.
Yeah, look, it's certainly a teaser here, and I think you might want to digest some of this. When we teach tax equity and transferability in courses, it's like 4 days. It's pretty heavy stuff. And I apologize on behalf of the IRS and the tax structures that we have here.
Fantastic. So look, what are the other key takeaways? Or are there any other key takeaways from the IRA? I know that there's been lots of talk around, bits on carbon capture and battery uncertainty. Does that play into it here?
Hugely. So there's a couple of other big ones that I spend a lot of my time on the advisory side. So, I mean, certainly batteries is a big one. Now, they didn't used to really fully qualify for the investment tax credit, 30% of the capital costs being recouped through a credit unless they were charged by solar PV. Now standalone batteries qualify. So that's a big reduction in capital cost that de-risks the investment to a degree. So we're seeing more batteries come about, but people are struggling with batteries here like everywhere else. I mean, we have more merchant markets, but like forecasting it, the one thing we know about a forecast is it's wrong. It's a question of how wrong are we? So that's one thing that we're seeing come about, especially on some of the distributed side of things. The other ones that are really starting to move along. So green hydrogen qualifies for a production tax credit. So that production tax credit that I focused on, that section 45 of the tax code, there's other ones. So carbon capture, so capturing carbon oxides, carbon monoxide and carbon dioxide and sticking it underground, qualifies for a tax credit, a 12-year production tax credit, as does green hydrogen. And green hydrogen's credit is huge. I mean, largely you could argue it's completely oversized. But these things come about from lobbying. So, guess we lobby for those things. But, green hydrogen has a big credit. So we're seeing a lot of movement. There's the federal government announced, 4 green hydrogen hubs recently in the US. So we're seeing a lot of movement, but from an investment standpoint, they're pretty early stage.
No, absolutely. It's all in its infancy. But we might talk again in 12 months' time, and it probably would gather considerable momentum.
And carbon capture too. I mean, that's a big one. Advanced manufacturing, you get credits for building things in the US now. So there's opportunities around that. I think there's a lot of opportunities on the service provider side, right, to be an EPC contractor. There's just so much going on. There's not enough people to do it, which is is lucky for all of us, right, being in the sector.
Haydn, you made tax interesting today, and I never thought I'd say that. And I think that everyone will agree the way that you have explained the complexities. And yes, you have just scratched the surface, because to go into detail, people would probably have to sign up for a 5-6 day course with you. Obviously, there aren't that many people that are so clued up on this, and therefore, for all of our listeners across the space, what is it that Pivotal can offer them? And can you talk them through, rather than just training them up? Can you actually advise them on a full scale start to finish project?
Yeah, absolutely. Thanks for asking. So clearly we provide courses. You can buy them online and do a license, but we do live classes in person and on Zoom, and we also go into organizations on tax equity. That's a big part of what we do. We typically won't go out and lead the tax equity transaction, but what we do a lot of is we coach and mentor and guide and consult. So, just because there's all sorts of rules in the US around these things, but what we are doing a lot of is we're working with clients raising tax equity. A lot of Europeans coming in, and we're in the background. They might get an investment bank on, but they're like, I want to ask dumb questions to someone. Can I ask you? And we're coaching them through it. We worked with a bunch of investors that have understanding the US market and building their first models to actually do it. Yeah. So we've built the models, but we do build the models. I like to coach them through it, just my teaching hat. But we provide a bunch of advisory services, bit of due diligence, looked at batteries for people, just reviewing of deals and investment committee papers, anything they're missing. And I like to think of us as just ask us questions, whatever you want, and we will help you do it. We don't need to be leading a deal. I'm happy to do 5 hours for you. As soon as we're no longer valuable to you, don't use us. That's kind of our mindset, right? We really want to upskill people to do things themselves. If it isn't fund, it's their investment, so they need to understand it.
Absolutely. Haydn, you've been an absolute pleasure as always. I think you've brought and offered a tremendous amount of value, and I think that anyone listening to this or watching this will agree that you've offered a lot of food for thought here. But clearly, tax equity plays an incredibly important aspect of investing across the US renewable energy market. If you get it right, and clearly there is a way to get it right, and there is clearly a huge upside. But please, let's not get it wrong. Let's speak to the advisors like you. But I would like to thank you for your time, and thank you for coming on the Infra Insider. And I think definitely one for us to pick up again in the coming months to see how the market's evolved.
Absolutely, and thanks for having me. And I'm sure a lot of the listeners on the Pivotal side now know a great recruiter to speak to.
Well, thank you very much. Thanks for getting that one in. I appreciate it.
Anytime.
Hey,
thanks, Daniel.
Talk to you soon. Take care. Bye now.
Bye-bye.